Hello Monday, are we ready for a new week? Well, I'm going to hit you straight up with central banking to start the week off. Because the central banking before, during and after crisis conference has gone on in the Fed over in Washington. I've read some of the PDFs already of the presentations and I'm waiting for the videos to come on the Fed website. Other people have got there before and are already reporting on it. This is the first report in number 2, Bank of England's King. New macro prud instruments still an experiment. Washington. Bank of England Governor Mervyn King Saturday at this conference said the new macroprudential tools sought by the central banks were still in an experimental phase and acknowledged little was known about exactly how many of the new tools were going to work in practice. For my mind, this is shorthand for, listen you guys, you're all talking about macroprudential policies. Do you really know what you are talking about? It's one shorthand word to explain some longhand stuff. But what is the longhand stuff that macroprudential actually describes? Speaking at a Federal Reserve conference in Washington, King also said it remained an open question whether central banks should focus primarily on their existing monetary policy tools or new macroprudential regulation to control risk in the financial sector. In other words, should they just wait and do interest rate up and downs? That's it, basically. Or should they pop bubbles before they see them? No, before they get out of control. This is an experiment, King said. He noted central banks were well informed on monetary policy, but we know absolutely nothing about how these macroprudential instruments are going to work. And he, like so many of the central bankers, really have not a clue what macroprudential means, but at least King has got the balls to come out and say so. Second link, same site. On regulation, King said it was important for central banks to show a degree of humility in their understanding of the financial system and chastised politicians for expecting central banks to use their absurdly magic powers to predict and control future economic conditions. Everyone is now looking towards the wizards, the high priests of the central banks to make everything better, which of course they cannot do. Central banks needed to try to get across to people that these problems were very severe and that we are focusing all our efforts to try to make sure that the risks that it will never happen again will be lessened. But anyone who thinks there is an easy route to that is mistaken, King said. And he's really telling the central bankers not to get above yourselves and start promising things that you can't actually fulfill, or getting yourself backed into a corner by either your promises or by very canny market profiteers. Third link, my link number 4, but same Bank of England, but this is Tucker this time. Rehypothecation consequences go under the radar. Bank of England Deputy Governor Paul Tucker Saturday said the practice of rehypothecation by primary brokers had fallen under the radar and suggested it may merit greater regulation by financial authorities. By using clients' money and assets, rehypothecation by primary brokerages means, in economic substance, that they are banks, Tucker said at a Federal Reserve conference in Washington. This is really a significant issue that lies absolutely under the radar. We have to think through what rehypothecation means and what we should do about it, Tucker said. And again, it's the central bankers that are taking it upon themselves to do something about it. So they are now going to have to do something about it because they say they're going to. Rehypothecation. If you've got a trading account, I used to have a trading account, money. I send them money by check or transfer. The money is there on the internet, says I've got the money, but of course they're using that money. It's fungible. They'll just use it among all the other money that they've got. But rehypothecation more comes in with, I say, buy an oil ETF. They buy an oil ETF, or a stock, would be normal stock would be better. I buy Apple. I buy a stock, so much Apple, and so they hold it for me, and it says on my screen that I own it. But then, to get more money, they take my stock ownings and repo it. They give it to somebody else for cash. They borrow the money from somebody else and put my Apple stock to them as the security for that borrowing. Now, where they got the money from, let's say B, has now got my Apple stock. They have legal ownership of it to a certain extent. It's all dodgy. So they then rehypothecate. If they're in London, they can do this. In New York, there's a certain that you can only rehypothecate so far, but London, you can rehypothecate as far as you like. So that B can take it and throw it into C for money, and C can take it and then put it into D for money. And you can imagine that it's very much like banking, and very dangerous. So the central banks have said, we'll have a look at this. So they better had. Financial Times money supply section, Shirakawa, 4 problems with aggressive monetary policy. And again, this Shirakawa was at the conference, and this is taken from what he said at the conference. Masaki Shirakawa, the governor of the Bank of Japan, for some reason I get a good vibe from him, gave a subtle and interesting speech this weekend that may not have been totally comfortable for his hosts at the Federal Reserve. Mr. Shirakawa set out 4 problems with aggressive monetary easing in the wake of a financial crisis. These are closely mirrored in the US debate about Fed policy, but on several points he took the argument further. Okay, so number 1, Mr. Shirakawa's first point is that loose monetary policy mitigates the pain as households repair their balance sheets. Good. But reduces their incentive to do so quickly because they're not under enough pressure. And I know I won't get through it. I won't get through it if I start wittering. Not just for the private sector, but for governments as well. Same. Governments aren't pressed to tidy if they have to, tidy their balance sheets up, because their interest rates that they're paying, especially the safe haven ones, are exceptionally low now. So they're under no real pressure. However, he also suggests that the effectiveness of loose policy may fall over time as households that weren't damaged by the crisis bring forward spending as they want to. In other words, if your balance sheet's in good order, interest rates are low, you might say, well, I'll take advantage and buy a new fridge, a new car or whatever. But the fact is that can only go on for so long because there are only so many people with undamaged balance sheets, and they only want a certain amount of goods. So that pulling forward only lasts for a certain amount of time. In other words, your loosening policies will give the economy maybe a bit of a boost, but that will soon wear off. Number 2. The second point seems the most dubious to me. This is the Financial Times, but would be profoundly important if true. Mr. Shirakawa suggests that low interest rates might induce companies to make investments with really low returns. Japan's endless public works, perhaps, and so low interest rates could actually cause potential growth to go down. He doesn't say this, but I can't imagine how this works unless some economic actors are credit constrained. What he's saying is, with interest rates, say, low, companies will take on projects with a very low, just above that rate, return on that investment. And then the expectation of return on investment is, after time, very low, where we'd normally looking for 15-20% return on investment. we are starting to get used to 5, and that means a low turnover of the economy, or something like that. 3 is the more standard argument that flattening the yield curve too far for too long will undermine the profitability of the financial sector. Yes, of course. 4. Shirakawa's 4th point is an argument about why banks such as the Fed should worry about the effect of easy policy on global commodity prices. In essence, he says that individual central banks that concentrate on domestic inflation targets, in other words, taking care of their own affairs, could end up causing global problems because their inflation is exported to others, which in turn makes it harder to hit their own domestic inflation targets. No inflation here, but we cause inflation there. We import things from there, therefore importing back in that inflation. And that contrasts with Ben Bernanke's clear statement that that isn't the way things work. Right, an excellent article by Tyler Cowen, I think it was in the New York Times, The Age of the Shadow Bank Run. I recommend highly that you read the whole thing. It's not big, it's not complicated, and I've just picked out as much as I can within copyright rules, I think. I recently asked a group of colleagues, and he's from George Mason University, and myself, to identify the single most important development to emerge from America's financial crisis. Most of us had a common answer, and it is that we are now in the age of bank runs. The age of bank run has returned. But it's not as easy as that. The new complication is that bank deposits are no longer the dominant form of modern short-term finance. The modern bank run means a rush to withdraw from money market funds. The disappearance of reliable collateral for overnight loans between banks, or the sudden pulling of short-term credit to a troubled financial institution. Now, this is what I've been going on about, whether you realised it or not. But these new versions are in some ways similar to the old. Both reflect the desire to pull money out of an endeavour and to be the first out of the door. And both can set off a crash, and this is what happened, and this is where the Fed came in to backstop, and then after backstopping actually had to take the market onto its own balance sheet and make the market itself by buying and selling, predominantly buying things like mortgage-backed securities. These newer forms occur in the so-called shadow banking system, involving short-term financial credit not guaranteed by the Deposit Insurance Umbrella, FDIC. According to the Fed, shadow banking accounts for about $15 trillion in assets, more than the traditional banking sector. To a greater extent, the credit crunch was not a banking problem, it was a shadow banking problem. Later in the article, it now seems that the 21st century will resemble the 19th and early 20th centuries, with periodic panics and runs on financial institutions, perhaps followed by deflationary collapses. In the Eurozone, these problems have plagued banks and entire countries like Greece and Portugal. The country as bank is a new and not entirely reassuring catchphrase, and it shows that the problem goes beyond the private sector. If a central bank is deft enough, it can avoid deflation by using loans and monetary policy to guarantee the liabilities of run-prone institutions. That worked reasonably well in 2008, but in the long term such a policy sets up the system for even more danger by subsidizing banks' risk-taking and precarious financial structures. Kind of what I've been saying, but it's very difficult to say. Is this the end? No, we've got 2 more. Another problem is that ending those central bank guarantees isn't easy. The European Central Bank has stemmed a financial collapse for now, but only by lending large amounts to banks at 1% for a 3-year window, the LTROs. And yet the Eurozone has entered a recession, so it's unclear when troubled European banks can return to private capital markets. The central bank may end up taking over much of the allocation of capital, and I say when they start taking it over, which they have, I cannot see how it's going to then go back out to the private world, which is well dodgy. The arrangement also assumes that economic growth will pick up fairly quickly in the Eurozone, which is hardly a certainty, and there is little market discipline to force European banks to clean up their balance sheets or to exercise caution in the future, so the system remains extremely vulnerable. It's kind of like the Shirakawa point. Everything has been made easy for everybody, so they're not really under mega pressure to clean their act up. And we finish with this entire package of problems seems to be part of the new normal. It's not going away anytime soon. Certainly not this week. Bye.